Welcome everyone. It's great to be with you today. My name is Catherine and I am a manager in the knowledge and technical team at A4S, and I'm excited to be with you here today on this webinar. In today's session, we'll be focusing on current investor landscape and sharing practical tools and insights to help you effectively communicate the drivers of sustainable value to investors. I'm delighted to be joined by Victoria Sant from Investor Forum, Chris Aldover-Ysmael from Metric Pacific Investments Corporation, and Kelly Hibbins from Ramsay Healthcare, who will be sharing their insights and experiences with us today. Please note that we will be recording the webinar for others, and it will be made available on the A4S YouTube channel and website later this month. There are 3 learning objectives for this webinar, and after completing today's event, you'll be able to follow the guiding principles and best practice for engaging investors on sustainability-related matters, understand the current landscape and key focus areas of investor relations teams, and translate the experience and learning of others from practical examples shared during the webinar to your work. Please also note that throughout the session, we'll be running a few poll questions which will need to be completed in order to gain CPE points. The webinar will last around an hour, and we're going to have a short intro followed by a panel discussion with our guest speakers about their practical insights and experiences. There will be some time for Q&A at the end, so please do drop your questions in the chat function and we'll do our best to answer them. So as a brief introduction, companies are experiencing growing expectations from investors to demonstrate and clearly communicate their sustainability performance. This is coupled with active incorporation of sustainability by investors into their investments and stewardship considerations. So whilst the expectations and motivations of both companies and investors are rapidly evolving, this does create opportunities for more collective and collaborative relationships, helping to enhance transparency and build resilience through collective navigation of sustainability challenges. So in the A4S Essential Guide to Enhancing Investor Engagement, we do actually outline 6 overarching guiding principles that every organisation can adopt to help guide how they communicate and interact with investors. And these principles will sort of set the scene for the discussion with our panellists today. So as an organisation, to develop an effective narrative for investors, this needs to firstly link to strategy. So sustainability needs to be built into the broader business narrative by linking it to strategy and communicating to investors how an integrated approach creates long-term value. It should provide context, so environmental and social factors do have significant impact upon business and the ability to generate sustainable financial returns. So companies need to provide context that is specific to their business, which quantifies these risks and opportunities. Thirdly, it needs to have a long-term focus. So impact, risks and opportunities may present themselves over varying time horizons. So companies need to position short-term results in the context of long-term goals. It should adopt a commercial tone. So to build the investor case, companies need to adopt a commercial tone which links sustainability to financial and operational measures, such as revenue growth, cost reduction, risk management, or staff retention. It should communicate targets, metrics, and progress. So integrating sustainability throughout all communications and not just as a standalone point helps to ensure conversations are prioritized and not just sidelined. So setting targets and using metrics allows investors to effectively assess company performance and is often used for rating agencies and index providers for performance evaluations. And finally, use standards. So companies should use recognized standards to report sustainability performance and get external assurance for the key metrics to ensure transparency and build investor confidence. I will now introduce our guests for today's webinar, so Victoria, Chris and Kelly. So Victoria is the Managing Director at the Investor Forum, leading collective engagements with UK-listed companies and projects focused on environmental, social and governance themes and promoting well-functioning markets. Victoria is also a member of the Investment Committee of the National Trust and a chair of the Investment Committee of the Global Crop Diversity Trust. She is also a non-executive director of Henderson Smaller Companies Investment Trust and an advisory board member of Ownership Capital. Chris is the Vice President of Investor Relations at Metro Pacific Investments Corporation, responsible for managing relationships with investors and analysts and ensuring alignment of interest with that of senior management. Chris has held various roles at MPIC in investor relations for the last 15 years. Chris was also part of the 2022-23 AFRS Academy cohort, where she focused on aligning MPIC's reporting to multiple standards and frameworks and developing an online portal for the collection of sustainability data across operating companies. And last but not least, Kelly is the Group Head of Investor Relations at Ramsay Healthcare. Prior to this, Kelly held positions of Head of Investor Relations at Suncorp Group, Vocus and Asiano, and spent 6 years as a board member and chair of the Australasian Investor Relations Association. Similar to Chris, Kelly was part of the 2022-23 AFRS Academy cohort, where she focused on formalising the process of engagement with equity analysts and investors to effectively communicate their sustainability commitments and progress on the implementation of reporting standards. So a very warm welcome to you all, and I will now hand over to Kerry, who will be leading the panel discussion.
Thank you, Catherine, and hello, everyone. My name's Kerry, and I head up our capital markets work at Accounting for Sustainability. We're going to go straight into the panel discussion now with our guest speakers to really get a bit more deep dive into their experiences and insights. We will have time for Q&As at the end, so please do post your questions into the chat function for our panelists, and we'll get to them in due course. I'm gonna start with Victoria. Can you, based on your work with the Investor Forum, can you please highlight some of what you're seeing as some of the current or emerging trends within the current market? And also, what are the priorities that you're seeing from investors in relation to sustainability, and what are they expecting from investor relations?
Yeah, sure. Thanks, Kerry, and thank you for having me today. So I should start with the disclaimer that all investors are not the same. They're not a homogenous group. They come at sustainability with very different motivations. They might be using it to manage risk, to spot opportunities to allocate capital. They might have this fundamental belief that sustainability is a driver of value, or they might not care at all. They might just be tracking an index or just have different motivations for this. But many do see a focus on sustainability as a competitive advantage. We've seen stewardship teams in the UK certainly grow over the last 5 years, whereas before you might have had one person focusing on corporate governance, you'll now have a team of professionals with a focus on climate and human rights specialists. So managers have really invested in this capability. They've been signing up to initiatives like the Net Zero Asset Management Alliance, where they've made firm-wide commitments on how they're allocating their capital. And like companies, they're going from having that ambition to what does that actually mean in practice? And so that's presenting a challenge for investors as well. Many are signatories in the UK to the UK Stewardship Code, which encourages them to engage with companies, to integrate ESG factors and to collaborate in order to create long-term value. And I guess they're doing all of this because the FCA has estimated that global assets under management in ESG-orientated funds would increase to $34 trillion by the end of 2026. So this is a huge pool of capital, and that's coming from clients who are increasingly having sustainability objectives in the mandates that they're giving to their investment managers. This might be the pension funds who care about the world that their beneficiaries will retire into and think it's a key part of their fiduciary duty, to purpose-driven endowments like the National Trust, and individuals, the man on the street, the investor who really cares about that. And we've seen regulators stepping up to protect these consumers from greenwashing, and so more strict disclosure rules on what investors can promise to their clients that they can do. In the EU, we've had their Sustainable Finance Disclosure Regulation, which has kind of settled in now, which has created these Article 8 and Article 9 funds that promote E&S characteristics or have a sustainability objective. And according to Morningstar, at the end of Q3 2024, this market had €6 trillion of assets under management. 60% of the available capital was in sustainability-focused funds and had 38 billion of positive inflows in the last quarter alone. So this is a huge pool, like I said, and the UK have just implemented their sustainable disclosure regime. 4 labels for funds in the UK: Sustainable Impact, Sustainable Focus, Improvers and Mixed Goals. So only about 30 funds have got those labels at the moment because the deadline's moved from next week to April, but more focus for investors for having to evidence why a company is in their portfolio, how it meets the criteria in order to have that label. And so I think that will flow down onto the engagement with companies of how the investors need to prove that the company that they've invested in meets those criteria. So what that means for companies is, I think, this is a huge pool of capital that they would like, I would imagine, to be eligible for. And therefore, the challenge that I suppose we're going to discuss today is how they can kind of persuade investors and evidence them that they meet those sustainability characteristics that investors are looking to see.
Great, thanks. Thank you. Such a comprehensive response. So it feels like there is a real mixture between a voluntary kind of landscape for investors to voluntarily get involved with things like the UK Stewardship Code, etc. But also the regulatory is really upping their game on how to ensure mechanisms and infrastructures help avoid things like the greenwashing, or try and kind of curtail the greenwashing. And you've just talked a little bit about the kind of investor motivation, especially you mentioned the pensions and aligning with fiduciary duty. So that really segues into, I'm going to ask Kelly and Chris, both from your investor relation perspective. Victoria just mentioned about, there is a certain element of pressure on for investors to be able to prove that their investee relations are meeting the sustainability characteristics. So how are you finding the dialogue and type of engagement with investors on sustainability that are evolving? Are you feeling that the voluntary and the regulatory landscape is helping to put pressure on them? Give us a little bit about your perspective. Kelly, if I start with you.
Sure. So I think, and good morning, everybody, or good evening, depending on what time zone you're in. I think the last few years, COVID has really shaken up business models. And as a result, investors all of a sudden have perhaps realised that they don't necessarily understand, what are the key sustainable drivers of, different business models, or that perhaps some elements are more important than they, originally realised. So I think that has really heightened the focus of active investors on finding out more about what is important to the companies that they invest in. So what we find with the active investors anyway is that they're saying to us, you tell us what's important. What is important to your business and what is driving your business? How has COVID, and the pandemic changed that? Are there different sort of, business models emerging as a result of the pandemic? Do you have to change things? And just looking at how sustainable the business practices are. So in our case, for example, staffing has been, was a major issue during COVID. There's always been a shortage of clinical staff in the healthcare sector. But when COVID came along, that exacerbated that problem. And, since then, that has been a real focus for our investors as to, where are we looking for, what new ways are we looking to engage and bring on new staff, and how are we retaining staff once we actually employ them? So that's a real focus, and we ask that every result and every presentation we do. The first couple of slides are revolve around how we actually retain and train our staff to be able to run the business effectively. So that I think COVID has really brought a lot of those things to the fore. The other thing that I think has been brought to the fore is governance. It's always been a focus of investors, but I think in this day and age, the things that perhaps were tolerated in the past are no longer tolerated. And we've had several in there, and I know there's been a lot offshore of high profile CEOs of big listed organisations who have been embroiled in various activities, be they affairs and things like that within organisations that have actually hit the headline and have materially impacted share prices. So I think investors now, as I say, the tolerance for that sort of behaviour, whereas 10 years ago that would have been, tolerated, it wouldn't have been in the headlines, boards wouldn't have to deal with it. Boards are now being forced into positions where they are moving very quickly to change out CEOs that have been caught out, perhaps not behaving to the standard that society now expects of our leaders. So I think that's a really big change.
Kelly, can I just ask, Kelly, on that point, is that being reflected in the engagement you're having with the investors, or is that coming from the media only?
Yeah, that's absolutely being reflected on the engagement, particularly where we have board engagement. So we tend to do at least one round of investor engagement with our chairman and other members of the board once a year. And that can sometimes happen a couple of times a year, and that is now being demanded, whereas once again 10 years ago board meetings, investor meetings with boards were not as common at all. But now investors actually want to listen to the board, listen to how they think about governance within an organisation, how they test the culture, in a real sense, not in a reporting, just reading a report every month, but actually understanding the culture of the organisation, making sure that, there is stewardship of that within an organisation.
Okay, thank you, Kelly. Fascinating, and I'm sure yours isn't the only example of how COVID has really changed the landscape on this. And I think really interesting to know that the investors are coming proactively to you and asking, what are your material impact on this? Chris, from your perspective, how is the dialogue and type of engagement investors around sustainability evolving?
I echo a lot of what Kelly has laid out. Increasingly over the past years, we've seen how investors are really drilling down more on sustainability related impacts, whereas previously a lot of the engagements that we have were focused on the economics of the business. And some of them even go as far as having their separate stewardship teams to really go into more detail, scouring through a lot of the data that's put out in the integrated reports, or perhaps in a lot of the questionnaires that are put out there for us to answer. But for us in MPIC, what we've found quite effective is really to go back to our strategy. I was happy when Catherine made the intro earlier, and she said that it's important to really link sustainability to strategy. And that's what we've tried to do, because typically what we do in MPIC is we view sustainability from a holistic and end-to-end approach. We call it EESG because we want to spell out economic, environmental, social, and governance, because there's a number to everything. And when we engage with investors, we know that those numbers are important to them. And so we make sure that instead of just focusing on the environmental or social aspects, we also try to highlight what the numbers mean for them, whether it's accessing more opportunities for increased revenues, or perhaps lessening expenses, which ultimately is a byproduct of doing sustainability in the right way. And that's how we just try to communicate with them.
That's interesting. And are you finding that the investors are responsive to that ESG approach?
I think so. I mean, it was effective even with our own board, because a lot of them initially were I wouldn't say quite hesitant, but it took a while because they're, traditional profit-oriented sort of principles. But over time, that is what we use to explain to them the importance of sustainability, because it's easy to shrug it off as just another cost center. When you're trying to be more sustainable, it usually comes with an added cost. But then you overlook the fact that if you do it right, it will actually be better for the business. And us focusing on the economic aspect help. And in fact, another way that we were able to sort of put skin in the game is we are one of the first companies in the Philippines to actually link compensation to sustainability related goals. Admittedly, in the past, our incentives were focused on economic achievements or economic targets. But over the last 2 years, we've added ESG targets as well on our waste, on our trainings, governance, and all that. And what we did, our board asked us to be accountable for it in the sense that it's sort of a right minus wrong thing. So if we get it right, if we hit the targets, we get a plus. But if we don't hit the targets, we get a deduction in our bonuses. So that's the sort of accountability that they require from us.
Okay. And on that point, and generally what you've been talking about, Chris, do you think that the sector and the region in which you operate affects how sustainability is featured in your engagement with investors?
Definitely. I mean, for those who are not familiar with Metro Pacific Investments, we are one of the leading infrastructure investment companies in the Philippines. And with that, we are heavily invested in the utility sector. So we have power distribution, power generation, water distribution, toll roads, among many others. So if you look at our major impacts, we are still heavily invested in coal, unfortunately, because being in the Philippines, we actually have the most expensive power in the region because our power costs are not subsidized by the government. Everything is passed on to the consumers. And in our country, there's no carbon pricing mechanism yet. So unfortunately, our company Meralco is still mandated to distribute what is determined to be the least cost of power. And absent any carbon pricing mechanism at the moment, coal is still unfortunately viewed as the cheapest option. And as much as we want to fully transition to renewables, the country is not ready, and particularly our customers are not ready to bear the cost because the government is not ready as well to subsidize that transition. So when we talk to investors, we acknowledge that this is our major impact. We do have a transition plan over the years, but this is highly hinged on the maturity of regulation in our country. Obviously, we would need support from the government as well to be able to implement this. But corollary to that, we also invest heavily in biodiversity protection because we believe that it should be a two-pronged approach. That while we're working on absolute contraction of our carbon footprint, we also need to protect our biodiversity. Being in the Philippines is one of the 17 mega biodiverse countries in the world. So we have to protect those natural carbon sinks. And MPIC is really heavily investing on that. So that's how we communicated to them that, yes, we recognize that this is our major impact. Unfortunately, these are the social realities that we have to contend with, but this is what we're doing hand in hand with the reduction of carbon footprint and the protection of biodiversity. So it's sort of giving that balancing act when you communicate to them.
And does that mean that because what you painted around the need for regulatory and policymaker development, does that mean that macro stewardship, so rather than just engaging downwards into the investee companies, there is like macro stewardship as defined as is engaging upwards to policymakers and regulators? Does that then feature in your investor engagement, or your engagement, I should say, engagement strategy?
Definitely. And it's not just focused on sustainability, because being in the utilities industry, our businesses are heavily regulated, not just on the sustainability side, but even on our tariffs, even on our volume. So everything is regulated. We can't just increase tariffs without the regulators going through our numbers, right? So that sort of being able to communicate to investors that we are very proactive in our dealings with the government and in policy making is very, very important, especially with our line of business.
Okay, thank you. Kelly and Victoria, I haven't forgotten you. Kelly, the same kind of question about the geography and sector. I mean, I think it's quite obvious from your current sector where the kind of natural material issues will come with around the social impacts, for example. But Kelly, you have a very diverse experience on different industries. Could you share us a little bit more detail on your insights from as well as current but previous sectors that you've worked in?
Absolutely. I mean, sector, there's lots of sustainability issues that are more sector specific than others. The other big one in the healthcare sector is modern slavery in medical supply chains, and that is an issue that will impact most companies around the world. But I think what we're finding in the medical sector is that the global industry, is trying to work together to actually help each other to identify problems in supply chains, because we all do tend to use a lot of the same consumables, and 80% of the consumables that we use are actually provided or manufactured or sold by large publicly listed companies in America and Europe. But obviously there are people that supply them, so the third party derivative, if you like, for us, that perhaps are not as well known in supply chains. So I think that is a really, it's a big issue for our sector, but it's also a big issue for a number of other sectors, particularly those that source product from the Asian region, because if you're using local manufacturers that perhaps don't have the same governance standards as perhaps a listed company, then that's an issue. I too, like Chris, have had exposure to the the resources sector through Asiano. We hauled coal, which was one of Australia's biggest exports. And so we, once again, we had to really help our investor base to provide a lot of information about the type of coal we were hauling, where it was being exported, why it was being used, how our customers were phasing that, the use of coal out. So our investors were actually really asking us to help them to explain, how the coal was being used, why it still needed to be used, why coal was still an important part of the energy mix, and how it was going to be ultimately phased out over time. And once again, we did work with miners in that case around, the sort of information about where the coal was going, the key customers, what they were using the coal for. So lots of work. I think lots of companies are working with people in the industry, with stakeholders in the industry, to try and provide, the information to investors around, sustainability issues around the business case.
Do you think this is how a transition plan structure will be able to help focus the sense of those conversations? You talked about the phasing out. Do you think the transition plans are going to be, or are starting to already be, an important part of that conversation?
Yes, absolutely. And I think that is, coming back to your first question around, the changes that around investors and what investors are asking. One of the changes, I think, is that investors in the past have been relatively short term. They're looking at, the next year, the next 2 years in terms of earnings. These transition plans, particularly in relation to climate and nature, are forcing them to look, 15, 20 years ahead, and, what, a company's transition plan to get to where they need to be in 15, 20 years. Because a lot of these issues around climate change, for us, we wouldn't say are material issues today, but in 20 years' time, they quite possibly will be. And so that is new for investors, having to look that far out and having to look at what companies need to do to actually transition to the position they need to be in that time frame. I think, yes, the transition plans are really important.
And Kelly, you started off this conversation saying that the investors are coming to you to ask about where your material sustainability issues are. So do you feel that the dynamic is really around you as the investor relations saying to the investors, the transition plans are important, this is how we're doing it, listen to us on it? Do you feel that there's really that you're the pusher, if you like, on what should be doing, and then they're listening to you on that?
Absolutely. I think this is a new world for everyone. And so I think what investors want to see is that we're thinking about it, and that we're putting things in place. Most investors will say to us, look, we understand that you don't have all the answers, but don't wait till you have all the answers to start talking us through what you're going to be doing and talking us through the transition and the impacts that you're discovering as you work through that. So I think, it's a new world for everyone, and I don't think investors expect us to get it right, all the time, or expect that what's in place today is necessarily going to be exactly what's in place in 5 years' time. I think people understand that it's a learning process, and they're just keen to see that companies are actually getting on with it.
Yeah,
I think, Carrie, if I may add, aside from us being pushers of this information, we know that investors do their homework, and a lot of times they've already, they already have their judgment on what they think is material to you, and they're just basically validating if you know what you're doing. They want to make sure that, okay, this is our assessment, and is the company acknowledging that, and are they doing something about it? That's also one angle to look at.
Okay, I think that's really important, Chris, to add that. So there is a real push-pull dynamic in this. Great. Victoria, what I wanted to ask you is around kind of investor communications. You referred right at the beginning briefly to the UK Stewardship Code and the proposed amendments to it at the moment. How are you feeling that the amendments to the framework will impact on the level at which investors are engaging, and with which stakeholders?
Yeah. So the proposed changes have got an interesting change to the definition of stewardship. It used to explicitly include reference to creating sustainable benefits for the economy, environment, and society, coming to Chris's EESG. And now it's just possibly considering, it's under consultation at the moment, just creating long-term sustainable value and allowing investors to interpret what that means, whether we need to explicitly put the environment in there, or whether stewardship is just, can mean anything to any people. So I think that will be interesting as to how that plays out and whether that will change investor behavior. Previously, there was a really big push on escalation and collaboration. And as a collaborative group for investors, we're really keen that investors work together, because I think what companies don't want is 100 investors asking them 200 different things. It's really helpful if investors can agree what it is that they think is material, what they want to see, and give a really clear message to companies. And so we really encourage collaboration. I think there's been a bit of a pushback from that in the US, and collusion versus collaboration. So that's been removed as an explicit principle of the code, as well as escalation, potentially, and like I said, under consultation. So we'd really be keen to see that continue. And then the principle around kind of systemic stewardship, I suppose, investors are being encouraged to promote well-functioning markets, and that idea of having a responsibility for the entire financial system and being involved in that. More investors are stepping up to that as they realise that a collapse of the financial system isn't something that can be diversified away by switching from one company to another, and that you need consistent policies in place from government. So more investors are engaging at that top level. We saw 650 investors sign a letter by the UNEP Finance Initiative to send to COP to really call for ambitious policies, to say that there is capital market support for going faster, for being more ambitious, that we need a strong policy environment to allocate capital, and that we want to see these policies. And also engaging on things like we've had TCFD, climate related, we're seeing nature related financial disclosures now, and a new task force on inequality and social related financial disclosures. And so if we can have these global frameworks that all companies kind of have an idea about how to do things, makes investors' job easier to have that comparability, that we've kind of done the thinking so everybody doesn't have to reinvent the wheel about what they're asking for. So I think there are lots of touch points for investors on this, and it'll be interesting, yes, whether the stewardship code kind of shifts that dynamic at all.
And do you find that the stewardship code has been effective in, I'm probably answering my own question here, but it has been effective in enhancing that collaboration and getting investors focused, so there isn't that kind of scattergun approach? Yeah, there's been some big initiatives emerged, like Climate Action 100 and those kind of things, and the stewardship code has focused on outcomes. So not did you just sign a letter, but what did you actually do and what was achieved by that. So I think by focusing on outcomes, that has changed behaviour and made people think about how investors are reporting and what they're actually kind of delivering for that. And Victoria, you mentioned the task force on nature-related financial disclosures and also inequality and social-related financial disclosures. Yep. Got that one right. So what do you think are some of the key focus areas, emerging trends for investors that will be in the next few years? Yeah, so Chris already mentioned biodiversity. I think that's a huge recognition now that what we've done for climate, we need to do for nature, and that we have a playbook now about how we can do this in terms of disclosure and kind of the action that we need to see. So I think protecting biodiversity is kind of a key thing. And the just transition, everybody's made these commitments. How is this going to impact broader society? Can we do it in a way that's socially just? So the key themes, but it's really interesting what Kelly was saying about modern slavery and culture. I think culture is a really key thing that kind of touches all sustainability issues, and investors are kind of thinking about, well, is that a financial indicator? How can I get insight into those kind of things? So the conversation is maturing from just, do you have a science-based target, to being much richer now on a number of issues, I think. Thank you. And Kelly, following on from that, what do you think some of the key focus areas for investors will be in the next few years?
Well, in Australia,
are you already seeing some of what Victoria said come out?
Yes, absolutely. We're obviously at the moment, as I think most people around the world are, focused on the climate accounting standard changes that are coming in, different timeframes in different parts of the world. For us, we've actually been given, in Australia, the Australian Accounting Standard Board has slightly altered, some of the changes, and so FY26, we've got 18 months to comply, but that is going to be a very significant change, because we now actually have to quantify climate impacts and materiality on our business in the actual financial accounts, and they need to obviously be signed off by our auditors and also by our board. So it becomes a much more serious issue, and I think that's going to be a very big change for investors. What we're trying to do now is to start that disclosure without putting numbers in yet. We are trying to start, or have started, lifting the disclosure around risks and opportunities to set that the scene for when we actually start to put numbers around some of these items. So I think that's going to be the next, that's definitely going to be the next big thing for investors, is when the accounting standards changes come through.
Okay, thank you. And Chris, similar question to you. And I think maybe referring to the work that you've done on your A4S Academy implementation plan, I think there was some kind of things that were coming out that would be relevant to say.
Yeah. Well, in terms of the major focus areas, I agree with it, with the things that Victoria and Kelly has highlighted. But just on the framework perspective, I think investors, not just investors, but reporters like us would be keen to see how the whole regulation and framework would evolve, because currently we have an alphabet soup of standards: GRI, SASB, TCFD, DNFD. And I know that the IFRS is slowly, going towards that direction of trying to consolidate all these standards, because there are a lot of overlaps anyway, right? So I think it would be good to get to a certain point wherein there's a unified global standard similar to financial reporting standards, right? That would be a giant leap for reporters and as well as investors, because then you don't have to be looking at all these many different frameworks and standards. And referencing it to the work that I've done for my A4S implementation plan, given that there's no unified standard yet, what we've done in our portal is to basically try to study all these existing frameworks, see where they overlap, and try to incorporate it into that portal that we developed. Because we did speak with a lot of the providers that have been offering sustainability portals, that what we found that they were sort of just cookie cutter, and they don't necessarily address all the major or the key parameters that our businesses are into, given that we have power, water, tollos, we have like a very diverse portfolio. So we thought it best to put everything together and develop our own portal, because we strongly believe that you cannot improve what you cannot measure. So it's important to have a robust reporting mechanism. And in the past, we've done everything manually. So at least now we have a portal wherein our operating companies can just log in and have a monthly cadence of reporting similar to the financial reporting that's currently being done.
Oh, fantastic, Chris. I think that would be great to just ask you now, segue into what we like to do of all these kind of webinars is, what practical recommendations would you give to peers and that specifically their investor relations team to enhance what we've been talking about here today, the engagement, the communication, sustainability with investors?
Yeah, I think there's a lot of sustainability information out there, and it's so easy to get lost in all the detail. It's so easy to get lost in all these KPIs that you have to report on. But I think when engaging with investors, just take the practical approach and make sure that you are able to communicate that you are fully aware of your impacts, your ESG impacts, and that you are doing something, that you have a plan to mitigate these impacts over time, and that it is tied to your overall strategy. I think that's the best way to start, and that will get the conversation rolling and sort of allow you to focus on these important matters rather than getting lost in all the detail of all the different KPIs out there.
Sure. So ensuring that you align it to your to your strategy. Kelly, the same question.
I obviously very much agree with Chris. I think the other thing is, perhaps from an internal perspective, to sort of make sure that everybody internally is focused on this. We've actually, over the last year or so, we now have in place sustainability-linked loans. So most of our financing is now linked to sustainability targets. And those targets are stretch targets. So I think when sustainability-linked loans first came in, there was a bit of, dare I say it, greenwashing perhaps around some of the targets. They were a little bit easy. They were easily met, and companies were getting the rewards from that. I think banks now are aware of that and now putting in sort of more stretch targets. I would just encourage everybody, don't be scared of that. We are not going to meet all of our targets every year, but we're certainly striving to meet them. And we've got plans in place that we can demonstrate that we're taking them seriously and we're moving towards them. So I think having those sort of things already in place are really good, not just from an external perspective, but they're great internally to focus people's minds on the key issues and making sure that we continue to focus on meeting our commitments. And the other thing, which is a little bit of a hobby horse for me, is around all of the assessments and surveys that we're as corporates are asked to fill out, mainly for the index funds. I would add. I do, and we're trying to do this at ERA, and I'm working with the Australian Stock Exchange as well to try and streamline the number of assessments that corporates are being asked to participate in. Because at the moment, everybody thinks their assessment is the most important. And I'm talking about things like CDP, S&P Global, FTSE for Good, the list goes on and on. And they're all interesting. And they're, relevant to some, some funds think one's better over the other. It is really, really difficult for corporates. And we're relatively big in Australia. I don't know how the small companies are dealing with this issue. I think the problem is that they're not filling out any, they're not participating in any. So we need, I think, globally to work as an industry to get these assessments down to one or two, assessments that include all of the relevant information. And we also use AI to help index funds in particular who need particular data to be able to scrape our website, so that as a corporate, I can put all of our information very clearly on our website, make it available for everyone, and people can use, AI tools to be able to scrape and pick up the information that they are specifically focused on. So I think they're two things that, as a, listed company in a corporate industry, we need to work on over the next few years, because it's sort of killing us in some ways. We're drowning in just filling out surveys.
Yeah, Kelly, I think that's a fantastic point to focus on. And I mean, I feel the pain slightly in the work that we're doing with the insurer and advisor community in the UK, where we've managed to get them to a place for the advisors to all agree on one sustainability related questionnaire that goes out to the insurers. That's a huge step, but we've been actually coordinating that kind of accumulation of all the different, and they are so different, even though they're asking very much the same questions. We've got to a place where they've all agreed on this, but it feels like a step change. But I can completely agree that this seems like a no-brainer. So yes, conscious of time, Victoria, I'd just like to go to you before we go on to our last poll, and then questions.
Thank you. So we've got some recommendations in a report that we recently did called Shaping Tomorrow's Dialogues, where we collaborated with A4S and 30 investors to really think about what companies do well and what investors can do better. And obviously a lot of it echoes what's in the A4S Essential Guide and what you've already said about being authentic, being integrated, aligning management through remuneration policies, building trust. But that last point, Kelly, came out a lot about the reporting burden and how we can do it better. But I would, say understanding how the ESG ratings work is really important, because investors are using them increasingly for that evidence that they spoke about at the beginning. And so learning how to feed the beast and how they're going to use them. And in the UK, the biggest index manager, Legal and General Investment Management, have on their website their ESG scores for company, really transparent about their methodology, who they're using for different things. And so I think companies to kind of have a look at what the investors are reading about them, and if they're scoring down because they don't have a policy, really easy win is to just increase the transparency or signpost a little bit better so that this can be filled in, because investors want it spoon-fed to them a little bit, and they are using this, and we're seeing calls for the ESG ratings agencies to be regulated, and so that there is a little bit more kind of openness about this. But I think that there is a market, and people do have different things that they think is material. So I don't think there's going to be one output, but there could be one input. So I suppose to your point, Kelly, that's something that we can work to.
Well, and also I agree, Victoria, but one thing that is a bugbear of mine, because all corporates around the world are increasing, the work in this area exponentially every month almost. But I'm finding a lot of these assessment surveys are using old data. So we found one, in fact, we had a conference call with one the other day where the data they were using on us was 18 months old because of when they do their surveys. And that's not great for investors. I mean, that doesn't work for investors. They're paying for a survey that's out of date. So we've got to be able to do something, I think.
Thank you, guys. We've run out of time, but that has been such a content-rich discussion, and hopefully those on the call today and those that will watch this video afterwards will find this really, really valuable. And I think there were some real tangible, practical actions and suggestions coming out of that. So thank you very much, Kelly, Chris, and Victoria, for taking up your time and sharing your insights with us today. So we're going to go on to questions now quickly before we finish. And I'm just going to find, we have one question from the audience, which is really wanting to understand how often does the carbon price topic appear in investor discussions? Could I ask Kelly and Chris to come in first, and then Victoria, from your perspective?
In our case, it's quite often because, as I said, our power business is really our biggest, the one with the highest impact. But unfortunately, as I mentioned earlier as well, we don't have that yet. So the conversation really revolves around what are we doing absent that sort of mechanism, and how perhaps some updates on what the government is trying to do in that aspect, albeit it's quite slow going. But yeah, so it's quite often in our, at least in our line of business.
It doesn't come up with us at all. So I think it's quite a sector specific topic with investors at the moment. I think mainly because most people don't think it would be material for us. I know if I worked at BHP or Rio Tinto or somewhere like that, that it would be, as Chris said, a topic that came out all the time. So but it's never been raised with me.
I think that highlights the fact that when you're talking to investors and sustainability topics, there's no one size fits all. This topic on carbon pricing is a clear example that it really depends on your geographical location. It depends on the nature of your business, right? So you really have to know your business well to be able to engage properly with your investors.
Yeah,
I think that's right, and it's good to see that it is materiality focused, and that if it's not relevant. But going back to that systemic stewardship point, I think investors are supportive of having some kind of consistent policy to put everybody on the same footing, so that what internal prices you use are reflective of the kind of economic externalities of carbon. So I think at a conceptual level, it is something that investors are considering and using policy advocacy to do, and looking at companies' policy advocacy on this as well. And so what we don't want to see is companies saying one thing internally and then engaging with governments to kind of undermine what they're doing and kind of get a low price, and so it doesn't really make it impactful.
Thank you. We do have one more that's come in. And I'm just reading it for the first time, sorry. So we're talking about methane emissions and non-carbon super pollutants. Are they coming up into investor conversations?
In our case, not in that much detail, at least for us, no.
Yeah, I know there are a few NGOs who are really trying to push that. NRGCC is one that kind of has mapped the methane emissions across the world and has asked the big emitters like Shell and Total to make commitments on methane and flaring, and looking at regulation around that as well. So I think it's something that the more climate focused collaborations like IIGCC and Climate Action 100 are going to kind of take up as one of the things that they focus on.
Yeah, no, it's not really raised with us. Water is more of an issue for us than methane.
I think then, as a final question, that leads from that, what do you find are some of the challenges that you've faced with getting investors involved in the material sustainability risks? I mean, we mentioned right at the beginning, Victoria, I think you set the scene where some are not interested at all. Are you finding that you have been able to overcome that challenge, or that kind of gap of interest in talking about what essentially is a material financial risk for you?
Who are you asking? Sorry.
Opening up to the floor.
Okay, well, so I think what we've seen in the US is that kind of pushback on considering any materiality focus. and investors are being sued for engaging to shut down coal plants or for doing anything. And so I think some of those red states are putting pressure on their fund managers that, you know, it's absolutely forbidden to incorporate this, even if it's financially material. We just can't do it from a philosophical perspective. So I think that divergence that you'll see between US managers kind of going one way and having one opinion, and the Europeans who, like I said at the beginning, have got a real support for this kind of thing. I'm less familiar with other parts of the world, and I'm going to, you know, you both have insights into different regions, but I think some investors, possibly the US ones, are going to be quite cautious about doing any collaboration or being explicit with the sustainability agenda, I think, for fear of what the legal ramifications that might be coming.
I think that's where the transition plan discussion comes in. I think people are very keen to see the transition plan and timeframes around it, because I think there is, as you said, you know, in the US in particular, but even elsewhere, I think there's definitely a focus on, you know, don't go, you know, there are some people who think, you know, you need to make sure you're going at a you know, certain pace that's not going to you know, completely change the economics of business or the returns of the business at the same time. So I think transition plan is going to become increasingly important.
For us in the Philippines, I think transition plans go hand in hand with resiliency plans, because we are beset by category 5 storms every month. So if you have, in our case, our power distribution business, we invest heavily in fortifying our poles, our distribution lines. So aside from the transition plan, depends on wherever you are and how heavily affected you are by extreme weather disasters, then you should also have a strong resiliency plan for your operations.
Thank you, everyone. We've run out of time now, so I'm going to pass over back to Catherine. So thank you very much again for your participation in this session.
Yeah, thank you very much all. We really appreciate it. So today we've looked at how investor engagement is changing, the challenges that this brings, and the practical steps that can be taken to enhance investor engagement. We will be linking a few resources in the chat today, so if you would like to sort of follow on reading, we've got quite a few at A4S. As we conclude today's webinar, I'd like to thank the speakers and their contributions, and also thank those that have popped some questions in the chat panel. And thank you all for joining the session, and I hope you enjoy the rest of your day.